The live intraday price for Nice Ltd on Nasdaq is $106.645, marking a significant drop of over 11.76% today. This kind of single-day swing, plunging from the previous close of $120.86, is the kind of sharp, immediate reaction that can cause panic among short-term holders, especially those who see a cloud software stock making a new 52-week low at $104.42, which happened earlier in the session. Now, the common expectation is that this massive sell-off is solely a negative reaction to their most recent earnings report, where the full-year earnings per share (EPS) guidance came in slightly below consensus, despite a revenue beat. That's the simple story. The reality is far more complex and involves a deeper structural change in how the market is now valuing not just Nice Ltd, but the entire customer experience as a service, or CCaaS sector. The insight you might not anticipate, the element that makes this current price action a coiled spring of tension between expectations and reality, is that the real pressure is coming from a quiet but forceful shift in institutional weighting away from slower-growing legacy cloud players towards pure, high-velocity artificial intelligence infrastructure and services. Sure, the company beat on Q3 revenue at $732 million, slightly above the consensus of $728.23 million, and EPS of $3.18 was right on target. These are decent numbers, but they're showing a cloud growth rate of 12.6% year over year. In a market fixated on companies like NVIDIA stock and others that are showing 30% or 40% growth tied directly to AI spend, 12.6% growth, while solid for a company of Nice's scale, simply doesn't cut it anymore for the growth multiple they had previously commanded. The lowered full-year EPS guidance, even by a small margin, became the catalyst for funds to exit a position they already considered too heavy on the valuation front for the growth profile. This wasn't a punishment for a terrible quarter. It was a preemptive strike based on forward-looking growth skepticism in a market obsessed with acceleration. The immediate stock movement today, therefore, is driven by high volume, over 1.8 million shares traded in the first half of the day, which is well above the average. This suggests a large block of shares being shed, likely by institutional players, rebalancing their books or simply liquidating a position that broke key technical support levels. The prevailing belief about Nice Ltd has always been that it is a safe, stable cloud software pick, a leader in contact center and financial compliance that benefits from the non-discretionary nature of its solutions. Investors often viewed it as a consistent performer, the kind of steady anchor stock that fits well within an intelligent portfolio or an individual brokerage account using platforms like Interactive Brokers or Fidelity. However, the reality we are seeing is that in the current market, stability is being penalized if it doesn't come with explosive growth tied to the current AI narrative. The market is challenging the idea that Nice Ltd's legacy dominance in the contact center market automatically translates to continued premium valuation. Their model, which includes product revenue down 24.1% and services revenue down 7.4%, shows the structural shift away from their older on-premise solutions is still causing drag, and the cloud growth, while positive, is not fast enough to fully offset that pressure in the eyes of the most aggressive growth funds. When you look closely at the segment performance from the latest report, the cloud revenue is clearly the future, but the sheer size of the company's non-cloud-related business is acting like an anchor. This is a crucial tension point for the investment narrative. Nice Ltd acquired Cognigy for nearly $1 billion and LiveVox earlier, explicitly aiming to bolster their AI and cloud offerings, particularly their flagship CX1 platform. These acquisitions and the introduction of AI-powered solutions like Enlighten Copilot are clear attempts to catch the wave. But the stock's reaction tells us that the market believes the internal transformation is moving slower than the sector momentum warrants. When you're managing your own capital through a platform like SoFi Invest or using the fractional shares option on Robinhood, you need to ask if the company's speed of transformation matches your required return profile, especially when other technology stocks are growing much faster. The market is saying, right now, no. This has created a contrarian opportunity, but one rife with execution risk. The expectation is that AI is good for everyone in software. The reality is that the market is ruthlessly selective about who is seen as a pure AI play and who is just an AI adopter. Nice Ltd is currently being classified in the latter camp. Delving into the business model, Nice Ltd is a global leader in providing software solutions for customer engagement, specifically for contact centers and financial crime and compliance. Their CX1 platform is the key cloud offering, integrating omni-channel routing, workforce optimization, and analytics. The compliance side, Actimize, is equally important, offering anti-money laundering and fraud prevention tools, highly sticky, mission-critical software. The bull case rests on the idea that these are indispensable tools, and as the global customer service industry rapidly shifts to the cloud, Nice Ltd, with its massive install base, is perfectly positioned to capture that move. The shift to a subscription-based cloud-first model should eventually lead to higher predictability and margins. However, the bear case, the one playing out today, centers on collection periods and the macroeconomic climate. While their North American revenue grew 5.3% year-over-year, overall growth is modest. The talk around macroeconomic pressures, specifically customers slowing down the conversion from capital expenditure to operational expenditure for large-scale cloud software deployments, is a very real factor weighing on this stock, more so than the earnings per se. The daily trading action has been brutal. The stock broke through its previous 52-week low of $120.12 and then plunged further. This technical breakdown often forces systematic and quantitative funds to sell regardless of the underlying fundamentals. The heavy volume suggests a clean-out is happening, which for long-term investors might present a better entry point once the dust settles. When a stock gets hit this hard, it's essential to look at the short interest, as a sudden upward swing could trigger a short squeeze. For investors managing their portfolios with investment help tools, seeing this kind of volatility should prompt a deep review of their original investment thesis. Is this an issue with the business, or is it merely a re-rating of the multiple? For a company with an $8.3 billion market cap and a substantial cloud presence, a nearly 12% drop is a massive repricing event that can't be dismissed as noise. Looking ahead, the future outlook for Nice Ltd is entirely tied to their ability to accelerate their cloud and AI story. The recent structural reorganization, appointing a new Chief Operating Officer, Arun Chandra, from Meta and Disney, to lead a new global customer operations division, is a clear signal from CEO Scott Russell that they recognize the need for faster, more cohesive execution. This appointment, effective December 1, 2025, is a major, underappreciated catalyst. It shows a commitment to operational excellence and integrating their acquisitions like Cognigy seamlessly. The expectation is that a software company's growth is inherently limited by its structure. The reality is that major management and structural shifts can sometimes entirely redefine its growth trajectory. The market is not giving them credit for this move yet, which is the tension that creates the investment opportunity. Potential catalysts that could change the current negative narrative include a clear acceleration in their cloud revenue growth rate to the high teens or 22%, an announcement of a major transformative AI contract with a Fortune 100 company, or an upgrade in their full-year guidance in the next quarter. The company has a solid balance sheet and operates in a dualistic space, which gives it inherent pricing power and customer stickiness. The risk, of course, is that the slowdown in cloud conversion continues, and that competitors, particularly those who are pure cloud and pure AI players, start to chip away at Nice Ltd's market share. This is the danger of being a legacy player in a rapidly evolving tech vertical. The financial compliance side of the business, which benefits from stricter global regulations, remains a reliable counterbalance to the volatility in the CCAAS space. For those of you who engage in self-investing and use platforms like the Fidelity mobile app or Schwab Intelligent Portfolios, consider how Nice Ltd fits into your overall technology weighting now that it's trading at these depressed levels. Do you see this as a value opportunity in a growth stock that has temporarily fallen out of favor, or a sign of deeper systemic problems? The analyst community, interestingly, still maintains a heavily bullish stance, with a high percentage of buy ratings and a consensus price target significantly above the current price. This gap between the market's immediate brutal reaction and the analyst's long-term view is where your individual judgment as an investor is required. Comment below how many shares of Nice